Guys, we're here today to celebrate a bunch of professionals who've worked very, very hard in creating funds for clients to use to simplify their lives. We set out in, I think, 2018 it was, to create these funds specifically for use by retail clients. Because we realized that picking from a list of 450 funds when you're trying to make an investment is a tough task. It's almost as tough as trying to analyze a bunch of stocks. So it's quite a tough task, and these guys have gone and they've said, okay, what we're going to do is we're going to simplify things. We're going to create a fund that's managed, that's a blend of other funds, and we're really going to focus on creating that for a specific target audience with a specific goal in mind. So from my perspective, welcome and thank you very much for taking the time, guys, especially you, our clients, to drive out here and celebrate with us. The day is all about the analysts and the asset manager in Cape Town, who's obviously not here, but we did exceptionally well in the Raging Bull Awards. We had all of the retail funds nominated for Raging Bull Awards. The Cautious Fund, which I'll be discussing, obviously won the Raging Bull Award, and the PSG Asset Manager won the Best Manager Award. So for us, it's a great milestone, and it's a great payoff for people who've worked very, very hard at creating something that results in ultimate client delight. I'm going to run you through a quick presentation of the multi-managed fund. We're going to try and get into the philosophy behind the fund. We're going to be discussing one or two stocks that the fund invests in and why they do that. And then we're going to show you which target market it's aimed at. And then once that's said and done, we're going to allow you some questions around the funds. I know some of you trade in stocks, and I don't know whether you necessarily invest in unit trust, but I think all of us have unit trust exposure somewhere, because we all have retirement annuities on some platform, preservation funds on some platform, and the underlying for that's typically a unit trust. And we have to decide as retail clients, myself, what the underlying is that we choose for that to get to the set objective or goal that we want to end up at. So without further ado, let's run through the presentation. We've created 3 funds, and we said that the typical retail client out there has either a income need, a very cautious approach to investing. It could be circumstantial. They could be close to retirement and not afford to lose money, and most of us take on too little risk and should be in something like a growth fund, which is basically a balanced fund, towing the edge of the regulations, because remember, a balanced fund has regulations that determines what kind of asset classes they can invest in. So those were the 3 funds that we created, and we've subsequently added our PSG Global Flexible Feeder Fund for those who want explicit offshore exposure. Dino and I have been catching up out here on the Rand, and I think taking full offshore exposure at this stage, I think it's a bit dodgy, because most of your offshore returns comes from the Rand devaluating. And this Rand's surprisingly strong considering all the troubles we've been having locally. All right, so to jump into it, we see there that we've got just the name so that you're not confused. It's PSG Multi-Management Multi-Asset Income Fund of Funds. The multi-manager has since changed its name to Investment Management for the reason that they don't only deal in funds, and they do equity portfolio management as well. So we've got the multi-asset income fund of fund. That's obviously seeking a higher income yield, and obviously for guys who demand a very high degree of stability on their capital. The middle fund is sort of the middle of the road. There's a bit of equities and there's a lot of cash instruments to keep the fund ahead of inflation, but to still preserve the capital and not risk the capital. And then obviously on the right-hand side, there's notable capital volatility, because that fund can invest up to 75% in equities. And we all know the equity market doesn't go like this. It goes like that lately. It's quite a bumpy ride. So obviously it explains the equity exposure. Your income fund has less than 10% in equities, 40% in the cautious fund, and then 75% on the growth fund, which I've said was a balanced fund, and then up to 45% offshore exposure. Most of the funds carry offshore exposure anyway. So when you invest in a unit trust fund, typically you'll have equities in there, you'll have some real estate, you'll have cash instruments, you'll have offshore exposure. It's a balanced, it's a portfolio of multiple assets created so that your money is grown in a diversified manner. I'm not going to jump into the detail. Obviously, the investor that would target the growth fund would be someone with a slightly more aggressive view. And as I've alluded, I think most of us take too little risk. We all plan probably 5 years ahead, and 5 years is too short a time period to ride out the ebbs and flows of the market. And in 5 years' time, if you buy an income fund, inflation is going to catch you. It's just a high interest rate environment that we're sitting in at the moment that's helping those cash instruments outperform. But the moment inflation starts settling down, you'll also see the rates coming down, and then the returns on those funds starting to go down a little bit, which would then necessitate you taking a little bit more risk and getting involved in something with a bit more of equity exposure. So I've just highlighted that there, the risk appetite obviously for the three funds is a guy on the side which is very conservative, a guy in the middle who's errs on the cautious side and needs a bit of stability in the performance, and a guy on the right hand side, he's quite au fait with the movement of the market, sometimes jumping up and down in a wild manner. All right, so the aim and the fund philosophy of the managers is obviously to optimize the yield. So they assess the yields across the different asset classes. They construct the portfolio with a solid yield in mind, and then they make adjustments as is necessary. In the middle column, we've highlighted that volatility is not risk. The market doing this is not risk. It's your ability to sit throughout that and accept the drawdowns as they happen, because they're mostly temporary. And if you look at markets over a very long period of time, they've sort of inexplicably recovered. We've seen numerous crashes, and then all of a sudden the market just runs. If you remember the housing crisis around 2008, it looked like the world was going to fall apart with big companies in the States folding. And then all of a sudden we had the biggest bull market we've seen in a long time. And all of that was wiped out. So our biggest risk as investors is not generating a real return. When I'm talking real return, I'm talking the difference between what your portfolio is delivering and what inflation's chowing away. Because I don't think considering a 6% inflation target is the real deal. I think we all find, and Simon and I have been discussing it, just if you look at medical aid premiums, there's no way those things go up with inflation, or the medical costs for that matter. I recently had a hospital visit, and when I saw the bill that the medical aid had to pay, I couldn't believe what they were charging for what they did. It's absolutely scary. So I think our risk is inflation, and I think when we invest in funds or when we manage equity portfolios, our aim should always be to outperform inflation. And only that return above inflation, or the real return as we call it, should be the objective. The value for money that you're getting by investing in these PSG multi-managed funds is simple. There's no performance fees. So it doesn't matter whether they perform or not. If they perform better, we don't charge you more. We've got access to institutional pricing from the underlying funds. So if you were to invest in PSG balanced fund with PSG asset management, you'd pay a certain fee. But because we're doing it in a bulk way, they're giving us a discounted price. So we can add the multi-manager's fee to it and still offer you a very competitive price for the performance that you're getting. And then obviously these guys follow an active strategy. We all know the debate between active and passive. Should you buy an index tracker, or should you actually back an asset manager to beat that index over time? It's fine in a bull market. But when something bearish hits the market, those index funds cripple you. Right. So the positioning of the fund, let's talk about the cautious fund quickly. You'll see there that it can have 75% in equities, but it only has 38.7%. That 38.7% gave us a nominal yield of 11.7, and that contributes to the portfolio of 4.5%. The 12-month number up until January this year was 10.4%, right, in this cautious fund. Since inception, when we started in, I think it was September 2019, Sidwell, we started the fund, it's yielded 11%, just over 11%. So it's really three fantastic funds, right? The bottom table, Sidwell, just to highlight, that's the real return. That's the real return that I was talking about. So you'll see that if you measure that performance against the inflation over the same period, then you would have grown your money by effectively 3.5%, more than the inflation rate. Right, so let's get to some of the stocks that these guys invest in. You'll see there, they invested in Anheuser-Busch, 3.3%, Discovery, 3%, Glencore, 2.8%, Standard Bank, 2.5%, JSE, AngloGold Ashanti, Wilson Bailey Holmes, Remgro, Northam, and AECI. So fairly diversified, right? There's some banks in there, there's some commodities in there, there's industrials in there. When we construct equity portfolios for ourselves and manage it, I mean, we all look at diversifying as well, as far as we possibly can. In most cases, retail clients don't have enough cash to construct an equity portfolio that is well diversified, because you can't have 30 different stocks in the portfolio. You've only got 300,000 Rand, and one of the stocks, Capitec, trading at 1,200 Rand, you know? So how many can you buy? But looking at the stocks that these guys have, obviously, I don't think you can go wrong over the long term with a brewer. I think the guys, especially in developing markets, will always drink beer, right? And these guys are well positioned for that. Discovery, we've been discussing the medical aid premiums. And the reason why PSG Asset Management are looking at Discovery is because Discovery makes less than 50% of their income from their life business. We've seen the life companies take a hit during COVID because they had unexpected claims due to loss of life and so on. They've been slow to recover, but Discovery is diversified in the sense that they've got the medical aid, they've got the life insurer, they've got the bank, they've got Vitality, and they've got all these partnerships with all these people that we use. And we were talking also about booking flights through with Vitality and that. Now they actually catch you and they ring fence you and force you to use their product and keep on paying whatever they're charging. So it's a great business model. I think in some sense it's a monopoly almost. And Simon and I were saying, well, what's our alternative? You know, when I look at my medical aid premium, I'm thinking, gosh, there must be something cheaper. But there's cheaper stuff, but I'm not sure they're going to pay the way that Discovery does pay. So Discovery, obviously one of the firm favorites, and our asset manager thinks, hi, come in, please join. Our asset manager obviously thinks that they've got long-term prospects, good long-term prospects. Obviously, Standard Bank is their favored bank. We had a discussion this morning with some clients about FirstRand. We also think that FirstRand's offering a lot of potential. And simply from the perspective of corporate lending, they've got a lot of exposure to corporate lending, FirstRand, Standard Bank, most of the banks, and we think they've got legs because of that, because all these corporates are now jumping to generate their own electricity. They're making huge loans to invest in infrastructure so that they can carry on doing business. And that's why we quite like the banking sector. I think from a South African point of view, our banks have been solid. I mean, we've got A-rated banks and there's no real risk of loss of capital when you've got money with any of our banks. So our banking system's nice and healthy. Obviously, we've got stocks like the JSE in there, which is a firm monopoly. They charge whatever they want to us as brokers, and you that trade securities have seen that. I mean, they've got a great business model. Whatever you do through the JSE, they just hit you per transaction. And it's not only trades, even if you move cash around. You use their accounting system, and once there's a line entry, they bill. So it's a good business. AngloGold Ashanti obviously has some good exposure and also earn a lot of their earnings from foreign currency. Wilson Bailey Homes, obviously just for diversification purposes in the property sector. Remgro seems to be of interest to the asset managers because Remgro's got some interesting companies inside of it. One of them, the talk of the town lately, being Rainbow Chickens. The split that's happening between the poultry business and the logistics business and the grocery business. And then also they've got Sequalo, which is the margarine business. It's also a monopoly in my opinion, because Sequalo manufacture Flora, Rama, Stork. So any margarine you can think about, it comes from the same place. And we think that over time, Sequalo, and that will be consumed, because that's also 100% Remgro owned, will be consumed and merged into maybe the grocery part of RCL. So some interesting stocks there. Obviously, Northern Platinum. The platinum business has not been great. I think that the platinum business may have some potential if the dollar weakens. We've spoken about earlier, myself and Dino, about the gold, and I think our asset managers also invested in gold because the US dollar is very strong, and gold has an inverse relationship with the US dollar. Short term, we think, yes, the dollar can get even stronger if Powell goes ahead and hikes another 50 basis points, but after that, really, once inflation starts coming off there, his currency is going to weaken and we're going to see a slight move upwards in the gold price. And from a diversification point of view, I think you have to have gold exposure somewhere in a portfolio, especially if you're a South African. I mean, that's our biggest export. The cautious funds performance since inception, obviously that's the blue line, and that's what makes these analysts very proud and make us very proud, and not the only reason why we won the Raging Bull Award, because you have to be consistent in your performance. You have to maintain a certain level of performance in order to win the Raging Bulls. And whilst our blue line has gotten past these guys and ran away from them, we also took a hit in COVID, but since then it's been good going for us on the cautious fund. But here's the one that's more important to us. And our aim as an asset manager and as a multi-manager and in the funds that we create for you as the clients is to be in the upper half or the top quartile of performance. So whilst we may not be the best asset manager every year, and this fund may not be the best fund every year, we want to remain in this green block. And if we manage that, it means that we've outperformed a lot of other funds. If you think about it, there's more than 1,000 unit trusts in South Africa. And if you can stay above those in your sector, or with those, the top ones in your sector, then your client's getting real returns. Same on the income fund, blue line well above the black line, which is the peers, or the CISA South African Multi-Asset Income Fund Index. So we beat them there on the performance as well. And once again, we're moving about inside of this quartile, but we're staying in the green. And the same for the growth fund. Just a little bit of interest or a little bit of information. As I've mentioned, the cautious fund has returned since inception 11%, which for a stable fund is actually very good. The growth fund has returned 14%, 14.5% since inception. And the income fund has done 7.8%. Now think about the times when we started this fund in 2019. Interest rates were in an absolute low, right? So you would have gotten from the bank maybe 3 or 4%, and you could have invested in a unit trust fund that made 8. So it's beating it by a mile, beating cash. Also in the top quartile. So to summarize, I think these funds are positioned for real growth going forward. I think these funds are thinking out of the box as to their stock selection, because we all realize that the Aussie 40 is not the South African economy. You do need some movement away from that. You need to be very picky when you pick stocks. Those of us that trade equities have seen that. We sometimes have the best explanation why a stock can go up, and then it just gets hit because it's part of the index, which doesn't really make sense. So having some index stocks and having some index exposure tracking the market, but also adding some other stocks is a prudent way to manage a portfolio, and I think our asset manager have gotten that right to a large extent. Obviously, adding the view from the multi-manager on top of what PSG Asset Management are doing has paid dividends for us, because we've blended these funds from our PSG Asset Management funds, and the returns were there for you to see. So, yeah, I think it's important to note on the right-hand side that past winners won't necessarily win going forward, but I think if we can curb drawdowns, align ourselves to the fund objective, these managers will, on a risk-based or risk-based, make risk-based adjustments for us, and you don't have to worry about managing the fund. Obviously, there's a couple of tools in the toolkit, and they're looking at cyclical counters, which are dependent on macroeconomic factors. They have some commodity exposure, as we've seen in there, with the Glencores and so on. And the platinum shares. On the local side, the fund manager likes local, because we think there's a lot of local stocks, especially on the industrial side of things, that's very fairly valued. We even think our banks are fairly valued at the moment. To talk to the fourth block there around the financial shares, and then obviously the funds heavily invest in government bonds and fixed income instruments to build sort of the base, or the baseline of growth, and then add obviously with a bit of equity as you move across the risk curve from income fund to cautious fund to aggressive growth fund. And that is my story. So we celebrate you guys, you analyst guys who sit up there. We don't often interact with you, and you guys obviously blend these funds to get these kind of returns for clients, and it makes our job for interacting with you, the clients, a lot easier if our funds are performing like that. And we wanted to organize this day to celebrate those awards that we've won. For us, like I said, it's a great milestone to win the Raging Bull Awards, not only as a particular fund, but as an asset manager. And it's nice to show stuff like this to our clients and say, hey guys, this is why you with PSG. Our ultimate aim is client delight. This is the way we're thinking. This is the way the manager thinks, and it's not often we have the opportunity to have a look at that, or the way that the manager thinks. So I'm going to throw the floor open. If you have any questions, I'll try and answer. And then obviously I've got Sidwell in the mirror. Sidwell's a senior fund analyst, so he would probably know the answer better than me. But if you've got any questions around these funds. Can I see show of hands? Who's got exposure to unit trusts? All of us. All of us. How do you pick a unit trust, if I may ask? If you then don't have questions, let me ask the questions. How do you pick a unit trust? Chris says he just picks one off the list. Okay, all right. I think, and I've tried to summarize it for myself, I think most of us go with the big asset managers, with a brand. We go with the Alan Greys, the Coronations, the PSGs of the world. And in the odd occasion, we go to a smaller fund, right? Because we've read something about them, or it's a niche fund, and we think that it's got a lot of potential. But I think on balance, we pick the bigger funds. But I think we often misalign what we're trying to achieve with the fund that we pick, because we don't fully understand what the philosophy behind it is, or what it is that fund's designed to do for us. So I hope with what I've done today is explain to you that there's basically three options. You either need income, and you need to be in an income fund of sorts that generates income through cash instruments that are liquid and that's fairly stable. You're never going to get 15% in an income fund, right? And then you get a cautious fund because you're at a stage in your life where you've got capital that you need to preserve, because in 5 years' time you need to retire, whatever the case may be. And then obviously if you're saving longer term, 5 years and longer, we should all be in growth funds at minimum, because we're going to get eaten by inflation if we don't go that route. Yes, have you got a question? Oh, okay, cool. No questions. Well, then I suggest we make our way up to the third floor. These guys know where the third floor is, and up there is also the dealing room. Yes.
Question on gold.
Please.
The only options are to go for the gold producers. Or are there any possibilities?
No. You can buy the miners, yes, but then I understand your question in that you're worried about your exposure to labor issues and all of those things, right?
Correct.
But you can also get exposure to the commodity itself through something like the New Gold share, which is a fund of actual gold that's stored in a vault, right? So you can buy the commodity. You don't have to buy the producer. You can get exposure to the commodity, and it's traded on the JSE. So you don't necessarily have to go that route.
Because if you listen to the McEwens of this world and all the juniors and what have you, especially in Canada and the US and all that, gold is projected to hit big numbers in the next 5 years.
I think you have to have gold in your portfolio for the sake of diversification, right? It's not only a protection mechanism against a move in the currency, but it's also protecting you. The demand in China and those places is busy coming back online, right?
Exactly, and Russia as well, because they want to have something backed by physical gold.
Correct.
So, all the central banks for the last year, especially 2021, 2022,
Correct.
they have been buying physical gold.
So, yeah.
So what does that tell you?
As much as, look, Russia is also a big gold producer, right? But they've caused themselves harm through this war in Ukraine, right? Which should have actually created some demand around the world for our gold. Funny, we've seen these central banks buy gold because they don't believe that the dollar can last as the default currency. And I mean, if you think about it, years ago we used to have the gold standard, and that was a protection mechanism against currency fluctuation around the world. So, two ways in which you can get gold exposure, and I think you should have gold exposure, is obviously the miners or through something like New Gold. Other than that, of course, you can buy Kruger Rands. I would just suggest if you do buy Kruger Rands, is to store them in your ceiling, because it's the last place breaking into a house will look for it. Don't put them in the safe. No.
Then my other question on resources as well. You say platinum is doing.
Platinum's got some issues, right? I don't know, Sidwell, if you want to add to it.
So short term, yes, platinum does have some issues short term, given what is currently happening, the labor issues in the industry and so forth.
What's happening? Sorry.
I'm saying that short term, there are currently issues in the platinum industry. You also had some challenges with, for example, Royal Bafokeng, the transaction whereby guys like Northam are trying to bid for them. So that has created a bit of volatility in the short term. But as we look forward, we see that platinum will be a required commodity in the shift to green types of technologies. And given that currently there is not a lot of money that is being invested in new production, that should be supportive of the price somewhat. But given that, in terms of supply, that should remain relatively constricted in the short term because no one is building new platinum mines. That should support platinum over the medium term. And as a result of that, and also given that in terms of attractiveness, platinum miners are quite attractively priced. Even if you look at earnings yield, for example, which is earnings per share over. What I'm essentially trying to say is that if you look at the valuations of the miners, the platinum miners are attractively priced, right? So even if you're seeing platinum miners are reporting short-term results that may be disappointing, over the longer term, they should do well.
I think the demand for clean energy is definitely going to support them. I think the platinum miners have got a problem in the sense that you've spoken about the Royal Bafokeng thing, where these other platinum miners are actually contemplating taking over Royal Bafokeng. Royal Bafokeng is then sitting in a precarious position. They can't really spend cash, right, to develop some stuff which is going to be taken over. They can't invest in people and acquire talent if they don't know if those jobs are going to exist tomorrow. They don't know what's going to happen post the deal. And then you've got people like Northam sitting on the other side of the deal who are being there's speculation that they contemplating taking Royal Bafokeng, and that's impacting the way in which the Northam share price is behaving, because even though they're producing and everything's going swimmingly at their mine, there's always the thing in the back of everybody's heads: what if they buy Royal Bafokeng? Will they be able to maintain that trajectory? So the platinum sector is a bit mixed at this stage. I think if I had to buy a platinum share, buy maybe Amplats.
So going back to my earnings yield comment, so it's essentially earnings per share over the share price, right? What that basically tries to tell you from an valuations perspective is how much you would essentially get in terms of earnings for every 100 Rand you invest, right? So for example, if I were to use a different example with Glencore, the earnings yield is around 23%, which means that for every 100 Rand you invest in Glencore, you're essentially getting 23 Rand in earnings. And what that for us means is that it's attractively priced relative to other commodity miners where they're listed in the JSE or offshore. So asset management tries to ensure that they look at miners that are attractively priced, but not just also hold them for the sake of them just being cheap. But they have to have strong balance sheets and they have to be positioned for growth going forward.
Yeah, I think the mining sector is always a difficult one. Gold producers, platinum producers have always got complexities around labor issues. They've got complexities about collapses at their mines, infrastructure that has to be developed, and that's quite costly. Or infrastructure that doesn't get developed in time, which would essentially make them more money. I think it's been a tough time for them, but I mean we spoke about it earlier. I don't know who I spoke to about it, but Thomas, you said Neil Fruneman at Sibanya, he bought, when was it, this week, 10 million rands worth of stock.
Yeah.
So if the CEO is buying his own stock, then there must be reason or must be potential.
He was also about to start a mine in Mpumalanga, and I'm not sure what happened to that. It came out as a rumor at Indaba.
Yeah, I
From last month.
I unfortunately don't know.
I believe what's called the DRMI, Minerals and Energy Department,
Yes.
say they were too late to apply for the license.
So you couldn't start it.
There's no replacement of ounces.
I think
It's a real pity because you've got 70% of the platinum in the world
yes.
here in South Africa.
Yeah, I think it's a pity that we've got government influence to such an extent in essentially a business as well. Now saying that what you're saying is they didn't apply in time for the license. I mean, do these guys not think? But yeah, to put it, I heard a DJ on radio say something very funny. When they appointed this new minister of energy, or what, electricity. He said that's like Lesotho appointing a chief admiral for their navy. They don't even have an ocean. That's pointless. Yeah, so we've got that to contend with as well, especially around the miners. At least they don't have that influence over our financials or over our industrial stocks. Yeah. Anything else?
Thank you.
Sarah,
Yes.
Comment about cost, the issue of cost.
Yes.
For a small investor like myself,
Yes.
I'm very sensitive to cost.
Yes.
But for this account,
Yeah.
where we invested with a foreign exchange traded for a product.
Yes.
And every month when I get a statement, I see a percentage X being deducted from my statement.
Okay. Let me explain to you how the unit trust accounts typically work. And this is not only with PSG, it's across the industry, right? We don't charge, and the industry doesn't charge an account fee per se. So you wouldn't pay like with your Capitec bank account 40 Rand a month to have the account. Whereas typically with share trading accounts, you have an administrative fee every month, which is your account fee. And on top of that, you pay per transaction. On the unit trust, it works differently. We take the assets that's there and we charge a couple of basis points based on the assets that's held. Right? For a small account holder, it looks like it's very expensive. Right? If you take that percentage in view of the total money invested. But if you think about what it is you're getting, if you had to go out and emulate that unit trust by buying the shares yourself, you would have to spend time doing the research. You'd have to pay the transactional fees to execute the order, right, in order to generate your return. Whereas on the unit trust, the fee is based off your asset value, yes, but even and we're increasing our fees now on small accounts, so we're making it up to 50,000 Rand total asset value. Most people have more than 50,000 Rand across all their unit trusts. And the reason why I say that is I may have 20,000 Rand in my savings account, my voluntary investment unit trust investment. But most of us have previous pension money from our previous employer, which we put into a preservation fund. And that preservation fund's also backed by unit trusts. So in a sense, we're encouraging moving that together because we charge on aggregate assets. So only if you have less than 50%, right, would you incur the highest percentage fee that we charge. But let's use the highest percentage fee as an example. If you have 20,000 Rand in your unit trust account, and we charged you 1% as a platform fee, that means we're charging you 200 Rand a year. My math might be wrong, but it's about 18 bucks a month. You can't have a bank account for that. You know, if you think about it, realistically speaking, even if you have 50,000, 50,000 comes to 500, that's 41 Rand a month. 41 Rand a month for a fund that's professionally managed, that delivers this kind of returns, with a company that gives you a platform that's up 99.9% of the time, which gives you accurate statements, accurate tax certs, the ability to talk to a client service agent if you've got a query, the ability to speak to an investment specialist like Sean or myself if you had any query about a stock, about a fund, to help you make your decision. You know, I reckon 40 bucks a month is not a lot for what you're getting. But I hear you. The more it gets, obviously the more we charge, but the higher the assets go, the lower the basis points we charge. So it's a tiered fee structure. So a guy with 500,000 Rand would end up, and if he's in a PSG fund, he would end up paying 20 basis points, whereas you would now pay on your 10,000 bucks, you'd pay 100 basis points, which is 1%. Okay, does that explain? Okay. Anything else? Well, great. I believe we've got some snacks and wine upstairs, and we've got a beautiful balcony out there, so it's great for us to welcome you as our clients here. I want to encourage you, when we're upstairs, there's a lot of people here. Go and introduce yourself to some of them, right? We've got Chris there, who's head of our tech build, right? So you can chat to him about all stuff, technical, platform, and so on. You've got Sidwell to talk about the funds. You've got Thomas to talk about the funds and the asset management. You've got Sean there about the stocks. But you've got Anthea to talk to. She does our UX design. So if there's anything on the platform that you're thinking, gosh, you know, when I click here, then I have to go there, and could you not simplify this for me? Then go tell her, because our ultimate goal is to share with you, our clients, so that we can make your experience better. You know, so I invite you to speak freely to us. Let's have fun. Let's go have a drink. Let's celebrate. And well done on the asset manager and the cautious fund for winning. I think it's awesome. Thank you.